Hello and welcome to Let's Talk Business. Let's first start with how the markets performed today. Markets ended higher for the second consecutive day. Nifty Auto Index was the top sectoral gainer and it hit a record high in trade. Financials relatively outperformed while IT dragged the Nifty 50. Mid-cap index gained for the 11th straight session to post a record close. My colleague Alex Matthew joins us from the BQ Prime newsroom. And Alex, take us through all the highlights of the market action today.
Well, it was a pretty ordinary start to the trading week for the Indian equity markets, and very tight range is what the Nifty 50 traded in. In fact, just about 100 points or thereabouts from the high point of the day to the low point of the day. We ended with gains of about 1/3% or so for the Nifty 50, and we ended below that 18,600 mark. The broader markets more or less kept pace. You had the mid-cap index that ended just about flat, and the small-cap index that ended with gains of about 1/3% or 1/4% or thereabouts. The India VIX dropped even further, and that is indicative of a little bit of pressure that the bulls are facing in pushing the benchmark indices higher. But to talk about the sectoral picture, because this will tell you what exactly happened in trade today, you had the auto pack that really were the top performers. That pack as a whole gaining over 1% in trade today. And this is because that the month of May proved to be quite a good month for automakers across the board. You had Nifty Bank, Pharma and Metal indices that all gained about 1/3% in trade today. The private banks were the ones that were in focus. On the other end of the spectrum, you had the PSU banks that underperformed. You had the IT and PSU banks as a whole underperforming in trade today. Now, macroeconomics is going to be in focus all of this week. The MPC meet later in the week, of course, and on Thursday you'll have the outcome that will determine the course of monetary policy going forward. It's expected to be a pause on the interest rates, but more importantly, we'll have to see whether the growth expectations for the current financial year are revised upwards and whether the inflation trajectory is seen decelerating much faster than expected. What else? Crude, of course, was in focus all of today, and that's because of the sudden surprise cut in production that was announced by Saudi Arabia. Of course, the OPEC Plus as a whole keeping their production targets unchanged. The key movers in trade then, from the auto pack, you had M&M as well as Tata Motors, both of them among the top gainers on the Nifty 50. They hit 52-week highs. You also had Bajaj Auto, IndusInd Bank, Titan and Apollo Hospitals that all hit 52-week highs in trade today. Reliance Industries also proving to be a supportive factor, gaining over 1% in trade. Stocks and news, Tata Chemicals gained the most in 8 months after it announced the MOU to build a battery manufacturing facility. You had Som Distilleries that gained quite significantly, over 10% in trade after it reported a 40+% increase in its Madhya Pradesh business in May. And you had PVR Inox that gained also quite substantially, the most in a week after opening a 7-screen multiplex in Bengaluru.
And moving on, oil prices rose following Saudi Arabia's decision to cut production by another 1 million barrels per day. The output cuts by the world's top oil exporter will be implemented from the month of July. Now, Saudi's output would drop to 9 million barrels per day in July, which is the biggest reduction in years. But Saudi Arabia's decision is unlikely to hurt India. This is because Russia, with its discounted oil, has trumped all other nations to emerge as the largest supplier for India, with 42% share in India's fuel imports. According to Deloitte India, the price increase will be compensated by the Russian discounts to a large extent. We spoke to Aslan Ahmed of Argus Media about the future of crude oil prices. Listen in.
For this OPEC meeting, the Argus consulting team were predicting in the very short term, right, about ICE Brent $78, $79 and going up to around $80 in the third quarter, right? So, and this, we are assuming that China growth will actually be quite muted. The Argus consulting team predicts that China growth this year is only going to be about 700,000 barrels per day. And that's a lot lower than, I think, what the OPEC and what some other analysts have predicted. So we have tempered our expectations of China growth. And I think that China will grow, but it will be slower and it will not be as big as what everyone had expected at the start of 2023. I think that looking at where the fundamentals are, we should be in the low 80s at least, okay? I think that given if there's no extension in the Saudi 1 million barrel per day cuts, I think we would still be in the low 80s. We don't see the market going up to the 90s or to 100 at the moment. But I think that a lot of it, the upside, will greatly depend on Saudi Arabia's action beyond July and what they do with their production.
And Morgan Stanley's Ridham Desai says that India has achieved notable achievements on the global stage. While speaking to BQ Prime, the Alpha investor says that Indian companies are witnessing new profit cycles, which will lead to the market growth in financial year 2024. Here is a short excerpt of that conversation.
Just by the virtue of having a surplus, you don't actually create prosperity in the stock markets. It is to do with how your saving pool moves. Because if your investment rate is declining, then the current account will go into surplus. Is that good? That's not good. Not good. If your investment rate is rising, but your saving is also simultaneously rising, then that's great for the economy, it's great for earnings. Now the saving can go up on account of two things. Either the country as a whole saves a lot more, but then ultimately, there is only 100 rupees on the table. If you save a lot, then you consume less, you create less demand. So the other way of generating saving is by, and this is the way India is now achieving it, is to improve terms of trade, which is you increase your trade with the world, you get better pricing for it, okay? So your price of imports decline relative to your price of exports. So the fundamental change that's happened on the current account is not oil, it's services exports, okay? So what has happened during COVID is that the typical multinational CEO learned that it's okay to work from home, okay? Not just multinational, in fact, all CEOs learned that it's okay to work from home. And if it's okay to work from home, then it's a whole lot better to work in Mumbai and Delhi than it is to work in Florida, because it's very cheap. And that's why a lot of jobs have got shipped to India. And they're still getting shipped. Mm-hmm. And that is creating, so this is not just IT, okay? So you may not see it in the IT revenues, because IT is only one part of this overall services revenue boom that we are witnessing. And we've still not come to tourism, okay? Because when that takes off, then you get even further lift on your services exports. So the fundamental shift on the current account, which is why I'm so constructive, is that you get this shift in your pricing basket. So your export pricing is getting a whole lot better than your import pricing.
And in an exclusive conversation with BQ Prime's Neeraj Shah, Professor Russell Napier sounds an optimistic note about India and the emerging markets as well. He talks about the rise of capital flow to India. Listen in.
Economies will have to inflate their way out of the debt issue. If that results, could that result in significant flows out of DMs or from DMs into EMs, Asia Pacific, what have you, however you want to define them?
Well, the answer should be yes. Remember what's going on here. The first rule of a financial repression is to get your money out of the country. That's the first rule, because people just think of it as inflation being higher than interest rates, but there's much more to it than that. And it involves the government playing a great role indeed of steering where capital should be going to. And it's a direct attack on savers. It's an attempt to move money from savers to debtors. Yeah. Now, if you could find a country that wasn't doing that, you'd want to put your money there. Now, many emerging markets, including India, will not have to do that. India's debt to GDP ratio is low. Its private sector debt service ratio is low. There are many other emerging markets in the same situation. So you should expect a structural flow of capital associated with the developed world implementing those policies. Secondly, and this is a different story, but it points in the same direction, we have a deteriorating relationship with China. And I think most people watching will obviously be familiar with the sort of growing evidence of a Cold War. That should also attract more capital to where there is cheaper labour. So India and the emerging markets in general can benefit from both forms of capital flow coming. And I think one of the problems might actually be too much capital.
And sale of automobiles in India revved up in the month of May. Demand for electric vehicles led to the sale rising 10% year on year. Electric vehicles accounted for 8% of the total sales, while two-wheeler sales recorded a growth of over 9%, led by the marriage season and the recovery of rural demand. Sale of passenger vehicles also jumped over 4%, but it was the three-wheeler segment which saw a huge surge. Sales rose over 78% in this segment. Well, Nifty Auto also crossed the 14,500 mark for the first time, and strong monthly sales and improved availability of semiconductor chips aided this rally. VQ Prime's Sajid Mangat spoke to Gautam Duggad of Motilal Oswal, who is bullish about the auto sector in the medium term. Listen in.
FY18 was a very interesting year because it marked the bottom of the financial earnings and top of the auto earnings. What happened in FY18? Auto earnings peaked out at a total profit of 31,000 crores for Nifty auto companies. From FY18 to FY23, the same earnings came down from 31,000 to 25,000 crores, right? While in the similar period, the banking and financial earnings in Nifty went up from 45,000 crores to 210,000 crores. So this is how divergent the journey of two domestic cyclical sectors has been. So FY23 therefore is the first year after a long time where auto earnings have grown. We do expect this momentum to sustain because both two-wheeler, four-wheeler, and in fact CV cycle as well is quite good right now. We expect this momentum to sustain. Demand is strong. Order books are looking very healthy. Supply situation, which has impacted large part of FY22 and some part of FY23, has eased out a lot. And at the margin, you have seen commodity prices correcting too. So all of this means that auto earnings can have a very strong year again in FY24, which is what we are building in our numbers. We are actually expecting auto earnings to almost double in the next 2 years between FY23 to 25 and keep contributing to the broader index. So which is why we turned overweight on auto back in January, when we saw first evidence of earnings upgrades happening in auto after 15-16 consecutive quarters of earnings downgrade.
That's all we have for you in this edition of Let's Talk Business. Thanks very much for watching.